All right, welcome. Today, we're going to break down a really powerful method that could honestly save you from getting caught on the wrong side of the market. We're going to dive into a specific technique to help you tell the difference between just a little dip and a full-blown account-crushing trend reversal. So, let me start with a pretty bold promise. What if I told you that you could boost your win rate, maybe significantly, without even touching your core strategy? So how's that possible? Well, it's about fixing your roadmap. See, the biggest problem for most traders, it's not actually their entry. It's that they're just trading in the complete wrong direction. They're buying right when the market is about to tank. Okay, so here's our game plan. We're going to walk through this in 5 quick parts. First, we'll look at the trader's trap. Then we'll expose the flawed signal that catches so many people out. Next up is the good part, the 3-key cheat code. After that, we'll see how to put it all together, and we'll wrap up with why quality over quantity is the name of the game here.
All right, first up, the trader's trap. Let's really dig into what a fake out is and why it's so frustrating.
Okay, I'm sure we've all been here, right? This is the classic fake out. You see the price just pushing up, making these strong bullish moves. Everything looks perfect. You think, this is it, I gotta get in. So you buy, and then bam! The floor just drops out, the price reverses hard, and you're left holding a losing trade, just completely crushed. And here's the kicker. This wasn't bad luck. It wasn't some random market fluctuation. What you thought was a trend, well, it was really just a setup for a massive drop. It was a trap, plain and simple, designed by the big players to grab liquidity. They need to trigger your stop losses to fuel their own move going the other way. So the big question is, how do we avoid these traps? How do we spot a real reversal? Well, a lot of traders will tell you to look for something called a change of character, or ChoCH for short. But here's the thing, relying on that by itself, that can be just as dangerous. So what is a change of character? You can think of it as the first little whisper that a trend might be running out of steam. The market makes a higher high, but then it fails to make a new higher low. Instead, it breaks that previous low. It's that first sign that, maybe the buyers are losing their grip. But, and this is a big but, this is exactly where the danger is. Now, technically speaking, for a ChoCH to even count, it's not enough for just the wick of a candle to poke below that last low. The actual candle body has to break and close below it. But even when you get what looks like a picture-perfect, valid break like this one, there is a massive, killer flaw in trusting this signal by itself. And here it is. This is the killer problem. A standard change of character, it fails about 50% of the time. I mean, that's literally a coin flip. You're just guessing. What happens is you get a false ChoCH. The market breaks that little low, sucks you into a short position, and then whoosh, it just continues the original uptrend. You weren't trading a reversal. You were trading a tiny little pullback. Okay, so if a simple ChoCH is basically useless, what's the answer? Well, what if you had a cheat code, a filter you could use to weed out all those fake signals and only focus on the real deal opportunities? Well, that's what we're getting into right now. So here's the solution. It's a 3-key system that works like a filter. It's simple. If all 3 of these keys line up, you have a very high probability setup for a real trend change. But if they're not all there, you're not trading, you're just gambling. So what are these 3 keys? They are, number 1, higher time frame mitigation. Number 2, a liquidity sweep. And number 3, a double zone breakout. Let's break down what each of these actually means, starting with the big one, context. Okay, key number 1, higher time frame mitigation. This is all about the big picture. You know the saying, context is king? Well, it's absolutely true in trading. A real reversal doesn't just happen out of nowhere. It happens when the price runs into a major brick wall, a big supply or demand zone on a higher time frame chart, like the daily or the 4-hour. If it's not coming from one of those zones, it's probably not a real reversal. All right, on to key number 2, the liquidity sweep. Remember that fake out we talked about at the beginning? This is what's really happening. The market needs fuel for a big move, right? So what does smart money do? Right before they're going to drop the price, they'll push it just above the recent highs. Why? To grab all those stop-loss orders and trick eager buyers into the market. That's the fuel, the liquidity they need to power the real move down. And last but not least, key number 3, the double zone breakout.
This is all about confirmation. Look, anyone can break through one level of support. That could just be a fluke. But when the price smashes through two consecutive support zones and does it with real momentum, that's not an accident. That shows serious conviction and tells you there's been a real shift in power.
All right, so we have our three keys. Now, let's put it all together and look at the anatomy of a perfect setup when all these stars align. This is what we call confluence. It's beautiful. Check it out. First, price runs right into a major daily supply zone. That's key number one, check. Then, see that little pop above the highs? That's the liquidity sweep. Key number two, check. And finally, it turns around with some serious force and smashes through two different support levels. Key number three, check. When you see this, you're not guessing anymore. You are trading right alongside the institutions.
So this really boils it down to the crucial difference. A simple retracement? Yeah, the price dips, but it never hit that big higher time frame zone, so the trend just continues on its way. But a real reversal? That starts at the HTF zone, and it has all three keys confirmed. That's what signals a real trend change. Basically, if you don't have the three keys, you're just trying to catch a falling knife.
So why is this so important? Well, because it's about fundamentally changing how you look at the market. It's a total mindset shift away from taking tons of trades to only taking the absolute best ones. It really is about quality over quantity. Now, if you start being patient and waiting for all three of these keys to line up, you're probably going to find you take, about 50% fewer trades. And I know, for a lot of traders, that sounds like a terrible thing. But trust me, it's not. Here's why. Those three keys are your filter. And that 50% of trades you're no longer taking, those are the bad ones. Those are the low probability coin flips. You're filtering out the garbage. You stop fighting against the current, and you start learning how to patiently wait for that perfect wave and ride it with the big players. It means fewer trades, sure, but it also means a much higher potential for profitability. So let me leave you with this one final question to ask yourself. The next time you're staring at a chart and you see what looks like a reversal starting to form, just stop for a second and ask, am I trading the setup, or am I about to become the setup?